and the session today will focus on quantitative portfolio construction and risk management. Many of you might have noticed that post-global financial crisis, there's been a growing focus on risk management in the public markets. Private markets have been slow to develop this trend.
Yes.
And in fact, this session has been conveniently scheduled at 4:45 p.m. in the second floor conference room. I have, however, noticed this year many of the participants mentioning risk and mentioning downside protection and loss ratio and diversification throughout the course of the conference. However, whenever the notion of risk comes up, it's usually in a context of individual investment and not so much in a portfolio context. So why is it that risk is not on top of LPs' minds in the private markets? Is it because there hasn't been enough data to be able to quantify risks in the private market space? Or is it because portfolio level risks are less relevant in an illiquid asset class? Do LPs even agree on the notion of risk and what kinds of risks they are facing? So in this session, I will share with you the approach to risk that we use at HarborVest, and also illustrate our portfolio construction approach, how we think about allocation within the asset class, and we'll illustrate it on an example of a globally diversified portfolio. So when you decide as an LP to invest within the asset class, these are the types of questions you probably ask yourself. So how long will it take me to achieve a certain exposure within the asset class? What kind of return can I expect? How much risk have I taken? How much cash do I need to set aside to feed this portfolio? And when can I expect to see the returns coming back? Is it in 5 years or is it in 10 years? And then last but not least, how do I evaluate my performance on risk-adjusted basis? I can have two investments that have generated the same amount of return, but one has taken considerably more risk. How do I evaluate my performance on risk-adjusted basis is the question. So to answer those questions, what do you need? You need a large historical data set of realized returns to be able to assess what return you can expect from your investment. You need a model to be able to quantify, using that data, what the risks you've taken and what the expected return would be on a portfolio level. You need to backtest, obviously, the model, make sure that the results of that model are in line with historical outcomes. And last but not least, you have to have a way to integrate this approach into your investment decision process. As most of you know, investing in the private asset class is still more art than science. So how do you merge the two? So this is the way we think about risk, or we classify different risk types within the PE investing. Capital risk, which is the risk of losing capital at the end of your investment horizon. This is the risks that you probably thought about the most. And those of you who have diversified portfolios probably know that this risk is not large. However, you can measure it, you can think about the distribution of returns of your expected portfolio, look at a certain worst case scenario, say 99's probability. At the end of your investment horizon, what is the likelihood that you're not going to receive your capital back? Or what is the lowest return you can expect? And more importantly, will I, at this probability level, still outperform the public markets? Because at that point, you are running a risk of underperformance. Second risk, we call it realization risk. And it has to do with the uncertainty around the cash flows that you will receive from your investment. You can have two investments that will generate 2x at the end of your investment horizon. One is gonna not return any capital until year 12, at which point you get twice the amount you put in. The other one is gonna gradually return capital throughout the 10 years, and which one is more risky? Obviously, the first one is much more risky. There are opportunity costs to you to hold this cash on hand to feed the portfolio, and also as the time goes by, there is more uncertainty around whether you're going to get that return at the end of your investment horizon. And the way to measure it, you can also focus throughout your holding period at the volatility or variance around your cash flows, and you can look at the worst case scenario and evaluate how much cash do you expect to contribute within that window. And last but not least is what I term market risk. But in reality, this is the risk associated with the uncertainty around your NAV. As you know, NAV is really not the price of your portfolio. It's the accounting mark that has been assigned to that portfolio on a quarterly basis. And mostly it reflects the multiples in the public markets. It's not the value of that portfolio if you were to exit. So how much upside or downside there is to NAV at any certain period of time throughout your holding period. And obviously, as a risk person, I focus on the downside at a certain probability level, how much capital or how much downside there is in NAV. So at HarborVest, we have assembled a large historical data set of realized investment. The way we term realized is less than 40% in residual value. And we sliced and diced the data based on different asset class or sub-asset class, and we sliced it by vintage year. And you see the majority of the data is somewhere around 1995 through 2010. Buyouts and venture, virtually the same, a little bit of credit in there. This is not just our data, not just our realized investments, but also investments that we haven't made, but we have the data on their performance. And it's pretty robust, but the most important thing that I want to highlight on this page is that if you focus on average return and median return, you notice immediately that average is above the median. And from your statistical courses back in college, Statistics 101, you probably remember what it means. What it means is that your distribution of returns is not normal. And more importantly, because the average is above the median, it means that the distribution of returns has a right-hand skew. And the right-hand skew is more profound in the venture space than it is in the buyout space. Obviously, the standard deviation is also so much higher in the venture space than it is in the buyout space. So if you were to think about applying a regular mean variance framework to constructing your private assets portfolio, you would never invest in venture. Because you'd look at this median return, you'd look at your standard deviation of return, and you would forgo the asset class altogether. So now I'm going to illustrate how we measure these different risk types on various examples using the model that we have developed in-house. This model is a Monte Carlo-based model, and all it does is generates a certain synthetic portfolio structures, and by taking historical data, so no distributional assumptions that we make, no correlations assumptions, pure historical results. And here I'm comparing portfolios of US venture managers, and I'm increasing the number of managers as I move from the far top left to the bottom right. And the dot shows the risk of capital loss. So the way I call it ICAR here, at the 99th probability level. You see it's reduced. If you have only 3 managers in your US venture portfolio, this risk is substantial. You go from 56% risk of losing capital to 8% with 20 managers. And this is a diversified portfolio over 3 vintage years. This is the uncertainty around cash flow. So what this shows, beautiful colorful chart. So all it does, it predicts my cash flows going forward in a stochastic way. So I'm not only predicting my most likely scenario of cash flows, which most of you probably have to do on annual basis. What I am predicting on top of that is the confidence interval around that expected cash. And this is sort of a derivative of your typical J-curve. So this is annual intervals, how much cash flow at a 99th probability level is going to be the bottom part of it, and the 5th probability level is going to be the top part of it.
On a single individual fund basis or on a portfolio basis?
This is 15 fund US buyout portfolio. Obviously, that's a great question, because the more diversified you are, the lower the uncertainty around the cash flows. And there are other ways you can mitigate this uncertainty throughout secondaries, for example, or other ways. But if you are sensitive to this risk, the more diversified your portfolio is, the higher the uncertainty, or the lower the uncertainty around the cash flows. And actually, we have some investors that are willing to trade the sum of the upside for reduced uncertainty around the cash flows throughout the holding period.
May I ask, this is, I assume the data is through an entire series of market cycles. Do you run ones as well that are influenced by, market cycles that you would identify as the same from different years? So, for example, you might
Only the stress periods?
Well, if you thought that the current environment looked like a certain group of years from the past, but not all I don't know how many years of data are in there. You've got good cycles, bad cycles. This on average will be right. It'll tell you what your bounds are, but your median is gonna be. You're not that likely to hit the median, right? Because it's so dependent on what kind of a drawdown cycle it is.
That's the whole purpose of this, running the confidence interval around it, because you're no longer focusing on the median. But a quick answer to your question, yes, we ran it for a co-invest portfolio, so I do have a sense of, because I cannot run it for a fund level, because at that point I just don't have a statistically significant sample. But in terms of a stress test scenario analysis, you still get a stochastic distribution around the cash flow, but you can do it only in a co-invest space to be able to realize that. But an important point that I wanted to mention is we actually trimmed the data set to remove all observations for vintages beyond 1995. So younger than 1995, we voluntarily removed from our sample because we didn't think they were representative of returns that our LPs can expect on a go-forward basis. And we have reduced the data set to only observations that had 20% in realized value. So only 20% in residual value left. So mostly realized. So last but not least, this is the chart that illustrates the uncertainty around the NAV. So as you start investing and the whole portfolio is investing, there is the largest uncertainty around the NAVs. You see that confidence interval is the widest. And there's quite a bit of downside. As your portfolio matures, there's quite a bit of upside and not so much downside. This is an interesting phenomenon that we have observed, actually, that there is quite a bit of upside left in the rare years, and some of the secondary players, I don't know if we have any in the rooms, but they are targeting these tail-end portfolios as a portfolio of its own to play on that optionality at the end of your holding period. So now I'm going to talk about, so now that we have established the risk types that we consider to be significant in PE investing, how do you mitigate those risks? The answer is diversification works beautifully in the private markets, primarily because you have right-hand skewed distribution. So you can take, as long as you have an opportunity to participate in the far right tail, those outcomes are going to more than outweigh your lower observations. So on average, your portfolio level return will be higher than an expected return on an individual investment, which is not the outcome that you generally see in the public markets, because the distribution of returns is actually right-hand skewed in the public markets, or left-hand skewed. And then what are the different ways that you can diversify your portfolio? Vintage years is a very strong diversifier. It's something that is beyond the manager's control. We all heard about the dry powder, the prices. This is a systematic risk diversification beyond the manager control. Geography is a very important one. We heard all about investing in Europe and the benefits of investing in Europe. When I think about the overall portfolio, it's extremely important. Asset class, this is venture versus buyout. What I've been able to show is actually that venture and buyouts are countercyclical. To the extent that you have a little bit of venture in your portfolio, it actually reduces risk on the blended portfolio basis, which is counterintuitive, because when you think about venture, you think about an asset class that is very volatile. But in the portfolio context, in the blended portfolio context, you are actually benefiting from it in the downtime.
Is that because of non-correlation?
Not perfect correlation.
Yeah.
They don't move. The cycles are not perfectly aligned. And then sub-asset class, this is small buyout versus large buyout. You want to be diversified across different sub-asset classes. The same in venture, you want to be diversified in early and late stage venture. And then last but not least is an investment. So here you want to obviously select the best managers, but have a few managers to be able to withstand the idiosyncratic manager risk. So this is a broad picture of, it's a little bit hard to see probably for those in the back, but this is a broad view how we think about portfolio construction in the private equity. So it's not just an allocation to the asset class. I have 100 million that I'm going to contribute to PE on top of everything else I have, and I'm going to divide it across 5 managers, 20 each. It's actually, the way we think about it is a collection of the building blocks. And we need to diversify each of those building blocks individually based on their unique risk-return profile. And what I mean by that is I will diversify US differently than I will diversify my Asia allocation. I'll diversify venture differently from what I will diversify buyout. And within buyout, I will diversify my large buyout differently from the way I will diversify my small buyout managers. So now I'm going to be focusing just one example of how you can apply this framework, or how we apply this framework for our clients, is on an example of a geographically diversified portfolio. So before I go there, this is public data, purchase data. I am aligning the geographical returns with all their imperfections by quartile. US, comparing US versus Europe versus Asia. And you see those tall bars are top quartile returns for Asia. So there's quite a bit of upside, there's quite a bit of downside. Dispersion is wider, but 2 important things. The penetration of the market is lower in those emerging markets. Dispersion of returns is wider, and the cycles are not perfectly aligned across the globe. So when one is going to be down, presumably the other is going to be up.
It showed the dispersion in Asia is larger.
Dispersion in Asia is much larger.
Looks like the bottom quartile.
Oops. So the bottom ones, you say you don't see the very bottom ones in gray, which is the fourth quartile. Yeah.
But the distance between the top and the bottom is
Yeah,
not
if you take out sort
bar
of
charts.
just I reading it, second, third, fourth quartile is a smaller band than in the other regions.
I would call it data imperfections. Because if we were to look at our data set, there are quite a number of underperforming managers in Asia. So this chart compares US only portfolio to a globally diversified portfolio. And this is a result of a simulation that we run on a synthetic portfolio. So I'm comparing diversified US portfolio that is 85% buyout and 15% venture with a globally diversified portfolio, same venture buyout weights, but here I'm only 55% US, 15% Europe, 15% Asia, and 15% rest of the world. This is not our recommended mix, but this is the mix that optimizes for risk-adjusted return. So if you focus on the table to the right of this chart, what you immediately see is that US portfolio has a 22% chance of returning above 2x. So broadly diversified, 3 vintage years, 22% chance above 2x. Net. Global portfolio has almost 50% chance of being above 2x.
Not only this,
Hmm?
you have access, if you diversify more, you have access to the right-hand side.
We're gonna get there. But yeah, this is why. So now, and the expected return is not so much higher because you have access to the tail. So your expected return for US only is 1.8, but the expected return for a global portfolio is almost 2x. So just a little bit under 2x.
Now, all these returns are in US dollars, right?
US dollars, yes, constant. And now you focus on the distribution of returns, you notice that your US curve is more bended, so it sort of resembles a bell-shaped curve. Whereas your global portfolio curve has this profound tail to the right, which you have mentioned, George. And if you selected very best managers in the very best vintage years, you gain that opportunity to outperform. And then what you gave up for that is this red area, which is reduced downside protection. But on a risk-adjusted basis, you've gained much more, and then you more than compensated for this increased risk. So summary, key investment risk types, risk of losing capital, realization risk, which is uncertainty around your cash flows, and then risk associated with the uncertainty around the valuations. You need a lot of data to be able to run this analysis, but there is publicly available data that is going to hint to the distribution of returns or the dispersion of returns within each of the asset classes or within each of the regions. Risks can be effectively diversified in the private equity space because the distribution of returns is right-hand skewed.
And bimodal.
Bimodal.
And bimodal.
Actually, for a lot of the sub-asset classes, it is bimodal, not everywhere, but good point. We view portfolio construction as a set of building blocks. That's very important because you want to diversify each of the building blocks regardless of the other building blocks. And then the weights that you assign to each of those building blocks are gonna be driven by your return expectation and your tolerance to risk. For example, if you are more sensitive to the cash flow volatility, you'll have a higher weight assigned to secondaries. If you want maximizing the outperformance potential, you'll have a higher weight assigned to those asset types that have the longest dispersion or the longest tail. Globally diversified portfolio has a higher expected return and a higher outperformance potential. Do I have some time for Q&A?
We need to move on quite quickly to the final discussion because a couple of the panelists need to leave on time. So I think if we have one question.
Very, very quick. Have you looked at diversification over time? I heard about vintage diversification, but diversification over time.
Yes, very good question. We actually, so each of those building blocks, we have done work. So each of them we can look into individually, and we did do work on the type and also
I'll
vintage.
text you later and ask you what you found.
And actually, in emerging markets, it's much more important. So
Exactly.
you need more
Exactly.
time diversification.
Hey, look, thank you.
Thank you.